The claim page told me my allocation was worth $1,140. I took about $600 for it. Roughly 40 minutes later, and nothing had gone wrong. That is the part worth sitting with. No exploit, no failed transactions. The two numbers were measuring different things, and only one of them was ever real. I had spent 4 months on that project. Wallets funded through separate paths, activity spread across weeks, a sheet tracking what each address had done and when. All of that went into the size of the allocations. I had put approximately no thought into the hour after it landed. Most people treat the claim as the finish line. It is closer to the moment the clock starts. Why I am the one saying this? I run mobile proxy lines and a rack of Android phones as a business. Real SIMs on real carriers, hardware in a room that needs its own fan. Every line has a cost sheet behind it. A SIM is about $10 a month. A modem loses roughly $1.50 a month over the life I get out of it. A powered hub carrying about 30 ports costs $150, and the machine under it is around $200. In that business, the sale is the beginning of the work. Somebody paying for a month means the line has to stay up for a month, and the margin only exists if it does. I came to airdrops with the opposite instinct, and it took two claims to notice. The number on the claim page. Start with what that figure actually is. The interface takes your token count and multiplies it by a price. The price comes from somewhere, usually a pool on a decentralized exchange that went live a few hours ago, or a futures market trading the token before the token exists, or the first prints on a centralized venue. Whichever it is, that price is the cost of a trade small enough to move nothing, a quote at zero size. Your allocation is not zero size, neither is anybody else, and there are a lot of you. So the dollar figure on the claim page is arithmetic that assumes you are the only person in the room. On the one day, the room is at its fullest, what the first hours are. The shape is the same every time. A large set of recipients who mostly want out. A pool of liquidity that is small next to what those recipients are holding. And the clock, because most claiming happens inside the first day. For you to sell, somebody has to buy. The buyers on day one are market makers with an inventory limit, people who want the token for governance or fees, and traders taking the other side because they think the selling is nearly finished. That is a finite amount of buying, meeting a supply that arrives all at once. And there is a detail about who is holding it. Almost nobody in that recipient's set paid cash for these tokens. They paid in time and gas and a bit of bridging. So the price that feels acceptable to a farmer on the first morning is anything above the fee. That is a much lower bar than the one a buyer is working from. And it is why the selling can go further than it seems like it should. What looks like a price chart on the first day behaves more like a queue. The earlier you are in it, the less of the move you wear. That is where the mechanism puts you, and it has nothing to do with how well you farmed. Down first the base, the sum I do before claiming now, this takes about 5 minutes and almost nobody does it. Work out how many tokens are actually claimable at launch. That number is on the tokenomics page. It is usually a fraction of the airdrop allocation, which is itself a fraction of total supply. Then find the liquidity, the size of the main pool, or the depth on the books at whichever venues have said they will list it. If the claimable float at the quoted price comes to $200 million and the pool holding it up is worth $8 million, you already know something about the first day. You do not need an opinion on the project to see it. I am not going to hand you a ratio that means good or bad. I do not have one, and anybody who gives you one invented it. What the sum does is put a sense of scale in your head before you are looking at a moving number. The schedule that outlives the launch. The launch takes all the attention, and it is the smaller half of this. Every token has a supply schedule. It is a document saying who receives how much of the supply, and on what dates. The team holds a slice. The investors who funded the earlier rounds hold a slice. And then there are ongoing emissions, paying for liquidity or staking or whatever the next season of incentives turns out to be. A cliff is a date before which a group receives nothing. On that date, a block unlocks at once. After it, the rest usually releases in slices, monthly or daily, depending on what the contract says. Emissions are the part people skip because they sound small. A program paying out 1% of supply a month is adding 12% a year to the float every year, whether anybody wants it or not. The property that matters is that none of it cares what the price is doing. It is a contract. It releases on a clock, which is how a token can go down for a year with nothing wrong with the project. The team ships, the users show up, the fees climb, and every month there is more supply than the month before, arriving into a market that is roughly the same size. That is a supply story. Supply stories are slow, and they do not look like an event, so people go hunting for a reason and find one in the news. A number that looks enormous. Two figures get quoted for every tokens: the market capitalization and the fully diluted valuations. The first multiplies the price by what is circulating. The second multiplies it by everything that will ever exist. The gap between them is the schedule with a price attached. A token with 10% of its supply liquid at launch has 90% still to arrive, and every bit of that has a date on it. I have no idea what any of that does to a price, and neither does anybody else with any honesty. The dates, though, are published. You can read them the week before you claim, instead of finding out about them in a chat group afterwards. The unlock is a calendar entry. The first large unlock after a launch is the one that catches people out, and it should catch nobody out because it was written down before the token existed. I keep a note with 2 lines per token I hold: what fraction is liquid today, and the date of the next release with its size. 2 lines. 4 minutes with the tokenomics page open. It is the only thing I have found that reliably changes how I behave. It works because it moves the thinking to a moment when nothing is happening. Your allocation may be on a schedule too. One thing worth checking before you make any plan at all: your allocation might arrive in pieces. More projects vest the community side now. Some at the claim, the rest over 6 or 12 months, occasionally with a cliff of its own sitting in front of it. That changes the question entirely. You are no longer working out what to do with a balance. You are working out what to do with a stream, landing on dates you do not control, into whatever conditions happen to exist on those dates. The tokenomics page says which one you are in. I have watched people plan around a full allocation and then find out on claim day that a quarter of it was liquid and the rest was a schedule. Read that line before the day. There is no version of this where finding out late helps what a decision actually is. Here is the part I expect to get argued with about. If your plan is to see how it trades, you do not have a plan. You have a screen. Deciding while watching a price move is not deciding. The move is doing it for you. Up feels like proof you were right and should hold for more. Down feels like proof something is broken and you should have gone already. Both arrive fully formed, and both of them are just the shape of a line. A decision made in advance sounds dull next to that. Take this fraction on the day and the rest after the first unlock, or take all of it in the first hour, or keep the whole thing for a year and accept in advance that you will watch it do anything at all in the meantime. Any of those is a position. Every one of them beats working out what you think at the same moment 10,000 other people are working out what they think. The 2 I got wrong. I wrote down that I would take half on claim day and hold the rest through the first unlock. It was on paper. On the day it went up about 60% in 3 hours, and I sold none of it, because a plan that says take half feels stupid while the number is climbing. Then the unlock arrived. The amount is not the interesting part. What matters is that I had my own answer written down and overruled it with a chart. The second one is the opposite mistake, and it embarrasses me more. I emptied an allocation in the first 10 minutes on a project I had worked on for 5 months and genuinely rated, because the first candle was red. No rule there either. I reacted, and it was exactly the reaction I would have been rude about if somebody else had described it to me. My sample is small, by the way, a handful of claims over about 2 years, not hundreds. I can describe the mechanism with some confidence. I cannot tell you what it will do to any particular token, which is the thing you actually want and the thing nobody has. The day everyone claims, one practical note about the claim itself. The claim window is the most congested that chain will be all month, because the entire recipient set turns up at once. Fees in that hour can be several times what the same transaction costs the following week. If there is no deadline on the claim, Waiting a day is usually cheaper. If there is a deadline, that is something to know the week before rather than on the morning. The half, that is knowable. The pattern is the same across everything I do. Separate what is knowable in advance from what is guesswork, then build rules only on the first half. With a proxy line, the knowable half is cost. $10 for the SIM, $1.50 of hardware, a share of the hub and the machine. I do not know how long a customer will stay, and I have stopped pretending I do. With a token after an airdrop, the knowable half is supply. How much is liquid now? How much arrives and on what dates? Who receives it? And whether your own allocation vests before you can touch any of it. The unknowable half is the price. Every hour spent guessing at, that is an hour not spent on the part you could simply have read. The write-ups, the supply notes, and the checklists I actually use are all there. Everything is at airdropfarming.org. Subscribe for more on airdrop farming.